How did corporate culture cause Wells Fargo scandals? Imagine working in a place where hitting sales targets is the only thing that matters. That's exactly what happened at Wells Fargo, leading to one of the biggest scandals in banking history. The bank's culture focused heavily on making as many sales as possible, no matter what it took. Employees were given very high goals for opening accounts and selling products. These targets were so tough to reach honestly that many workers felt pressured to cheat. They opened fake accounts, enrolled customers in services without asking, and even issued credit cards without approval. All this was done to meet the sales numbers, not to help customers. The problem started at the top. Managers and executives set these aggressive goals and rewarded employees who met them. They often ignored or dismissed ethical concerns. If workers didn't hit their quotas, they risked losing their jobs or getting demoted. This created a work environment where doing the right thing was less important than hitting sales targets. Employees felt they had no choice but to cut corners. The pressure was so intense that unethical actions became common practice. Management initially blamed lower-level staff for the misconduct, but investigations showed that the push for sales came from higher up. Senior leaders fostered a culture where profits and growth were more important than honesty or customer trust. This top-down attitude made unethical behavior seem acceptable or even necessary. The scandal hurt Wells Fargo's reputation, which was built on trust and stability. It led to fines, lawsuits, and the resignation of key leaders, including the chief executive officer. In response, Wells Fargo changed its approach. The bank eliminated sales goals tied to product numbers and shifted focus to customer service. They also put stricter controls in place to prevent unauthorized accounts. This scandal shows how a company's internal culture can push employees toward misconduct when profit goals overshadow ethics. It's a clear example of how corporate values and management practices can cause major economic disruptions and financial scandals. When a company values growth over integrity, it risks losing the trust of its customers and the public.